I thought just to start at the very beginning, what is it that made you start investigating private equity?
Yeah, so my first job out of college was working in private equity. So I spent 4 years in the industry, and I got assigned to look at what had happened during the financial crisis and what had worked and not worked in private equity. And so I started looking at private equity from a quantitative angle, and it was a fascinating project. There were three big insights from that early project. The first, the private equity deals are really small relative to the scale of public equity markets. So, to frame this in terms of numbers, right? You think of like the S&P 500 of having a market cap of about 50 trillion. So 500 companies, about 50 trillion of market cap. The Russell 2000, which is four times as many companies, which is the small cap index, has a market cap of about 2 trillion. Private equity, there are about 12,000 private equity backed companies, and the market cap of all of those is about 2.4 trillion. The second thing is that these tiny companies, the sort of origins of private equity, they used to call it leverage buyouts, right? It's using debt to buy companies. So these companies are not only very small, but they're very levered. And when you contextualize that with the public markets, the S&P 500 companies are barely levered at all, right? Apple has cash, not debt. But the typical private equity backed company is about 60% debt finance. You kind of back into these numbers by looking at the size of the private credit market, which is called 3 trillion. So it's bigger than the private equity market now. And that roughly parallels, right? You have 2 trillion of equity and 3 trillion of debt sitting on top of these 12,000 really small companies. And that's the private equity asset class. The sort of third insight from the study was that comparing valuation multiples and saying how much do you pay for one of these small private companies, how much do you pay for a public company, and for kind of 20 years or so, from the 80s till the early 2000s, private equity was buying companies at about a 40% discount to the public markets, which makes sense, right? You're buying a tiny subscale company that is not big enough to have caught attention of other people. You should pay a lower price for it. You're paying it at an illiquidity discount, which is how you earn your illiquidity premium. And then you could go and sell it. The good ones you could sell to a strategic for a higher valuation, or you could IPO them at a higher valuation, right? And there was this natural process. And if you were really good and you got one of your guys promoted from the minor leagues to the major leagues, you made a lot of money, right? And that was the model. But probably in 2005, six, right before the financial crisis, what happened is that private equity started to get more popular and deal valuations started to converge. So instead of paying that 40% discount, all of a sudden you were starting to pay sort of actually quite normal prices for private businesses, not that cheap bargains that you had before. And then post 2010, and really in the last 15 years, you've seen private equity valuations go through the roof to where it's more expensive to buy a private company than it is to buy a public company, because every company is going up for auction and there are 20 or 50 or 100 bidders because everybody and their mother has a private equity firm now. Again, if you sort of take that 2 trillion number relative to 50 trillion for the S&P 500, you come to a sense of like, okay, if I'm sort of index weighting, I should have about 4% of my US public equity allocation in private equity, something like that, 4 or 5%, right? And if I'm 60-40 stocks bonds, then maybe I should have 3% of my overall portfolio in private equity. But you look at what the quote unquote smartest people in the room are doing, and they're putting 40, 45, 50% of their portfolios in private equity. Like you look at Yale, Harvard, Brown. And by the way, like you go down the top 10 college endowments and look what percent they have in private equity. It's all like 40%. There's no outliers. There's no divergence. It is complete consensus groupthink that you should have 40 or 50% of your money in these tiny, tiny little really levered companies. And how everybody came to that conclusion and why there's no disagreement, I don't know, but it is true. And I think the sort of basic logic and facts, when you sort of hear why all this money has been going into this tiny set of tiny companies, and you try to figure out how people are going to make money off it, you're sort of like, well, why am I going to earn such higher returns by paying 2 and 20 fees, to buy tiny little companies at higher prices than public markets using a lot of debt, when those companies are mostly small and low margin? People talk about foreign stocks and they say, well, I don't want to invest in Europe because there's no European Google. There's no European Nvidia. It's like, well, there's no private Nvidia. There's no private Google. So why are you putting 40% of your money in privates? Like these are subscale, relatively crappy companies. And yet, investing massively overweight to this stuff is the best idea that all of our smart allocator friends have had.
Let me play the devil's advocate. I think if you are Yale or if you are a large endowment, you don't have any comparative advantage in investing in the public market, but you have two comparative advantages. One is disappearing, but two comparative advantages in investing in private market. The first one is that you're not supposed to have any major shock. Before Trump, universities did not have any liquidity shock, and so they could afford to lock in capital for 10 years. That's one source of comparative advantage. Second, they actually know their alumni very well. It's very difficult to sell information. Okay, this is a point. I know you are a student of Canaro, so Arrow is the first one to point this fact. It's difficult to sell information. However, if you are an alum, you can pretty easily donate information to your alma mater. So, and by the way, there is a level of trust. The comparative advantage of endowments is precisely to invest in private equity. What I don't understand, we're going to come later, why we want to have the individuals invest in private equity, but that's a separate thing. I think at least historically, and maybe 40% is an overdoing, but historically, I saw a reason why they were sort of overweighting that particular segment.
Yeah, so I think that the first idea, there are two, right? The first is the idea that you should get paid for taking on a liquidity, and the second is that you should get paid for superior managerial skill.
Or
And
picking
I'll
good managers, or having the information to pick good managers. Yeah.
Yes, and I'd say for the first, my argument would be that to earn an illiquidity premium, you have to purchase at an illiquidity discount, right? You can't pay more than the public markets for the asset and then expect to earn an illiquidity. Like you paid a premium to buy the asset. Where's the discount, right? Like I think it's really hard to argue that you're getting a discount in private markets today, right? There are
But
just
I'm
too many
sorry,
private
Dan. Do
equity
you
firms.
really believe the accounting numbers of private firms? And it's just when you buy from an owner, maybe it's because of my Italian origin, but when you buy from an owner, the owner makes everything possible to hide the earnings, right? That's a different.
Yeah, but I think if you look at, there are a lot of studies by S&P and others that the adjusted EBITDA numbers that private equity assigns to these companies and the models that they use to underwrite their deals tend to be about 30% higher than what actually occurs. So there's about 30% of these add backs that are really kind of phantom. So I'd actually argue that there's a massive overstatement of EBITDA by private equity firms relative to the true cash economics of these businesses. And so I think on top of the, like you're adding back all the stuff and then you're paying quite a premium price. And I think, just the, it's basic like auction math. Like you only need two parties at an auction to have an efficient market. And if you have 17 parties, what's the case that like one of them is just kind of crazy or desperate? And I think that's the state of private equity today, right? Talk to any mid-market private equity firm and say, tell us about the last 15 sale processes you were in. Were they competitive, not competitive? They'll tell you it's crazy competitive. Like there are way too many private equity firms, and that's not a recipe for earning, for buying things at a discount. And so if you're not buying at a discount, how do you earn a premium, right? Like you're in the most overheated, overbought market there is. You're not getting any bargains. And you have to get a bargain to earn a premium. So I think yes, great, you have a long view, but that doesn't necessarily get you anything, right? Like unless someone's willing to pay you for it, and they're not. I think that the next thing about managerial skill is the same argument would apply to active public equity management. Like, couldn't you figure out who the best guy at Fidelity was because he went to your alma mater and he calls and tells you? So, like, why is it necessarily you do that in private markets? You could do it in public markets too. You could know that Ken Griffin's a really smart guy and invest in Citadel. I don't think that necessitates a shift from public to private, or necessitates any specific asset class just to choose the best people. I think the only argument that private markets maybe might offer in that regard is the idea that these private equity owners are improving the companies that they buy, that they're running them better than other comparable people, and that the source of alpha in private equity is operational improvement. And I have a very healthy skepticism of that idea.
Talk a little bit more about that skepticism of the idea that private equity is delivering operational improvements, because it's documented skepticism. It's not simply my form of skepticism, which is opinion-based skepticism.
Yeah.
So then that was the first study of yours that I had come across years ago.
Yeah. So I like to start with sort of like, again, your sort of basic common sense, like who do the private equity firms hire? Well, it turns out they hire a bunch of investment bankers. And then you say, well, where in your investment banking career did you suddenly learn to run Midwestern industrial businesses, right? Like if operational improvement was the key driver, why don't they hire a bunch of like ex-CEOs to run these companies or ex-middle managers or sourcing people, right? In fact, those people are sort of like a serf class within private equity, that they're in the portfolio group, that the all the partners are the deal guys, right? So what are they good at? They're doing deals. Like it's not about operational improvements, and never was, except as marketing. But I think that there's a lot of the way I've sort of tried to document this is looking at all the, so some portion of a smaller portion these days, but a larger portion historically of private equity deals issue public debt at the time that they do a deal. And when you issue public debt, you have to report the last 3 years of GAAP financials. And then every year that you're issuing debt, that the debt is live and paying a coupon, you have to issue the financials to your bondholders. And so that public data is available for a subset of LBOs that issued public debt. And so you can look at these and say, what did the pre-transaction economics look like? And what do the post-transaction economics looks like? And you can control for sector and whatever, and do this in a pretty robust way, which is what I did. And what you find is that there's revenue growth slows a little bit. And my thesis for that is that private equity firms tend to buy things that look like they're high growth, but growth follows a random walk. So you buy stuff with high growth, and then it follows a random walk, and you end up with a little lower growth than you bought it at. Margins basically flat. But you see a massive increase in debt and interest payments and a decrease in CapEx spending. And I think that's sort of intuitive, right? Like it's an LBO. What do you expect? Like the reason they took control of the company is to increase the debt. That's what happened. That's what happens in every LBO. What happens in every LBO is an increase in debt. What happens in some LBOs might be an increase in margins and another a decrease in margins. Some revenue growth increases, but there's no reason systematically to think that private equity, qua private equity, is better at running companies than public's company CEOs or families or any other group of people. Otherwise, why wouldn't Harvard at their MBA program teach a whole class on like the private equity cookbook, how to run companies like Blackstone? Because there isn't a cookbook. It's just a bunch of investment bankers that buy companies and then sit on the board and yell at people to make the finances better.
But I don't know how familiar you are with publicly traded companies. There are plenty of inefficiencies. It's not they are perfectly run. And so I can see that having somebody with the right incentive sitting on top of a competent manager, because I think you mischaracterize a little bit in the sense that companies are run by proficient manager. You call them serve, but whatever. They make a lot of money, so they're not really exploited the serves. The only thing that the LBO's organization do, and then there is a question why they pay so much for that, but the only thing they do is they maintain some financial discipline and allow the firm to carry a huge amount of debt. In the sense, debt, even after the tax reform, that is tax favored. Before it was even more. So now you might argue that this is bad for society, but that's, in a sense, the fault of Congress that favor debt. There's a huge advantage of having debt from a tax point of view. The cost of having this debt is that when the proverbial S is the fan, you find it difficult to raise funds. If you have somebody on top of you that provides you the fund in those moments because they know and they trust you, then they allow you to run the company at a much, much higher leverage, which is, from a tax point of view, enormously efficient.
Yeah, so I'm sympathetic to that argument, Luigi, in that I think that there's no question, it's very well documented, that private equity sponsored companies are able to access the debt markets in a much more effective and efficient way. They get better terms, they get more forbearance when things go badly, they're able to take on more debt. They get treated better in restructurings. And I think that's consistent with my view that what is the private equity operational value add? It's that they are ex LBO and that they're ex investment bankers who, unsurprisingly, really know well how to do acquisitions and manage debt capital markets. Right. So I buy into that thesis completely, and I think that's one of the good things about private equity. I think, however, as a class, private equity backed companies run at much lower margins at almost every level than public companies, right? They're much lower margin. Part of that structural, they're tiny little companies and less diversified, less scaled than public companies. So I think it's hard to argue that they're, higher quality companies, right? Like, the highest quality companies are obviously in public markets, and the higher margin companies are in public markets. Yes, the private companies can be managed to hold a lot of debt, but that doesn't make them better run, more efficient, higher margin companies. They're certainly not that. And I think that debt, and I think it's sort of central to thinking about the private markets. Um, uh, that debt in good times in a market that's going up can be a lever to the upside. But when things go badly, obviously it's a tremendous problem to be very levered, right? You have a lot more downside risk, a lot higher bankruptcy, et cetera. And I think it, bringing us to this current moment where the S&P 500 is at all-time highs and the stock market is booming and the economy seems to be booming. Um, and for some reason, private equity can't sell their deals, right? Like they can't exit their deals. And you're like, well, if these companies are so good, why can't you sell them, right? Like it seems like a good time to sell. Like it seems like the public market's doing fine, IPO market's open. Maybe these companies just aren't that good, or maybe they paid too high prices for them, right? I mean, that's I think the sad truth here.